Hello and welcome to the lecture for part one of chapter two. So in this part, I'll talk about opportunity costs a little bit, a couple of other subjects, cost variation, and then we'll get into cost volume profit analysis up through break-even point. I'll talk about it a couple of different ways. And then in the second part of the lecture, I'll talk about an extension of break-even analysis, dealing with a little bit more complicated situations. And then I'll talk about some cost classifications, and then last I'll end with cost estimation. So two parts to this chapter's lecture. So opportunity costs are something that I can remember studying in economics classes, but never in an accounting class, because they don't really enter into the accounting equation. It's not a transaction that we record or that sort of thing. So the book talks about it quite a bit. I think the best definition in thinking about opportunity costs is it's a benefit foregone by choosing one course of action over another. So it's something that we would use in decision making, but you wouldn't see it on a financial statement, if that makes sense. So the example I have here is, let's say you've got excess capacity in your factory and you're leasing some space out to a neighboring company in a corner of your building, and you're getting $500 a month for somebody using that space. And you're entering a discussion about whether or not maybe you should do some more manufacturing in-house and stop purchasing some components from a supplier. So you're doing that analysis. What would be the difference? How much does it cost to make it ourselves? How much does it cost to buy it from somebody else? One of the things you'd want to put into that equation is the $500 in rent revenue that you would forego if you took over that space. In effect, that's a cost, an additional cost of making things yourself. So that's kind of what I get out of opportunity cost, and why I think it's a relevant thing is it's a component of decision making. Another definition from economics is sunk cost. So that's a cost that's already been incurred, it's in the past, and whatever good or bad you decided about that, it isn't going to affect a future decision. So you bought a used machine, it turns out it doesn't make the parts that you need to make with it. So the cost of that machine is not a factor in whether or not you should now buy a second machine to make those parts. Those are two separate decisions. So the key thing there is it's not a component of whether or not you should, what you're going to do going forward, but it's still used for full control purposes. So you still want to guard against overspending and make sure somebody's done their math well for what they have to do, but it's not something that we would think about for making a decision. So some definitions here, and hopefully this will be review that you've had this information, I think, in a previous class, but I want to go over it again. The reason for understanding cost behavior, which means how do costs change as different activity levels change or different things change within your business, how will costs change, is that you can use that information to estimate various outcomes. And I'll give an example at the end of this chapter's lecture about a real world example about how we would do that. So a fixed cost is going to be a cost that stays the same no matter what the volume is. So if I pay $10,000 a month for my warehouse for rent, whether I make one part or I make 1,000 parts or I make 10,000 parts, my rent is that same amount. It doesn't change. A variable cost is the opposite of that. So its definition is the cost of producing one more unit. So it's incremental or marginal cost. So that does change. So if we make 0 parts, we have 0 variable cost. Think of an example of a picnic table company. My fixed cost might be the depreciation on equipment and the rent for my factory and maybe the manager's salary. The variable cost would be the cost of the wood, the cost of the screws and bolts, the labor to make the parts and assemble it, and maybe commission that I pay a salesperson to get it sold. All those would be variable costs. So they're going to go up directly as my volume goes up. So one cost that kind of falls in between the two is a semi-variable cost. And a semi-variable cost has elements of both. And a really good example I can think of is utility cost. So let's say I have an electric bill from my factory, and I have electrical heat in the factory. So I might want the factory to always be at 68 degrees, so none of the machines get too cold even when we're not operating them, and inventory is maintained at a certain temperature, and some security system electricity is being consumed, and a couple of lights. So that amount of electricity is going to be consumed even if we produce zero. So that's the fixed portion of my electrical bill. Now the variable portion of my electric bill is the electricity that's required for all the machines that are running as I'm making picnic tables in that example. So if I make a lot of picnic tables, I'm going to use up a lot of electricity because I'm running a lot of machines. So it's going to have a variable component to it. So what we do with costs like that is we break them into their two pieces, so I can have, in that case, variable electrical cost and fixed electrical cost. So now I can say something about what my total electric cost is at different levels of production. There's a variety of different methods used to do that. I don't think this textbook gets into that, so I won't introduce that information here. I'm happy to talk to you about that offline if you want. The other subject is relevant range. So that's the range of likely activity that we're talking about. Outside of that revenue or relevant range, costs may behave differently. So say as an example, St. Martin's University. There's a certain cost to all the buildings. Okay, let's say depreciation on all the buildings. So that's going to be the same if we're between 1,000 students there and maybe 3,000 students. That's going to be relatively fixed. So that would be the relevant range, maybe 1,000 to 3,000 full-time equivalent students. Because if we talked about having 10,000 students, well, then we'd probably need some more buildings. So what was fixed is going to change. It's going to go up. So we want to think about relevant range when we're doing this work. So the way this looks graphically is where that angled line is right there, the straight line approximation, where it intersects the y-axis is the amount of fixed cost, okay, over the relevant range. So it's the depreciation, the president's salary, those kinds of things, rent on the factory, all of that. And that line is at a slope because as we go to the right, the more units we produced, our total cost is going to go up by the variable amount. So the slope of the line is the variable cost. So I can use something like this to say, well, what if my units produced are X? What is the total cost there? What if it's Y? That's going to be a higher amount. So this graph is a little bit more sophisticated than some in that it shows the total cost line not necessarily being a straight line. The reason for that is at the very, very low end, I might not have, maybe I don't need a supervisor if I'm making a very low number of parts. The workers can manage themselves. So maybe I have slightly lower costs there. On the other end, at the high end, total costs going up, maybe that means that because I'm producing outside of my relevant range, I'm having to work Saturdays and pay overtime, or I'm having to pay more for my raw materials because I'm getting them from further away to have enough, those kinds of things. So cost won't truly be a linear line. That's just what we do for kind of ease of calculation more than anything. So the other thing to think about are cost drivers. So cost drivers are measures of physical activity within a business that we believe are closely associated with a particular cost. So some cost drivers might be units produced. Okay, so units produced is going to drive the raw material we need. It's going to drive the direct labor that we need. It's going to drive maybe the electricity we use in the factory, those kinds of things. Another example of a cost driver is direct labor hours. So one example of a cost that direct labor hours drive is supervision wages. If I have a rule in my company that a supervisor manages 10 workers, well, as I increase the number of labor hours and have more workers, I need more supervisors. So that kind of activity is going to drive the cost of supervisors. The reason we look at cost drivers is if we try to estimate specific cost, we want to make sure that what we have on that x-axis is what's most relevant to the cost changing. Okay, if we are more careful about what we choose as a cost driver and we guess well in terms of the activity that really does drive the cost, we're going to do a better job of predicting. That line that we estimate is going to be closer to what the truth will be. So we can use different activity drivers for different decisions and for measuring different kinds of costs. In fact, we should. So cost, volume, profit definitions. And I want to say one thing about this slide. There's a couple points in this textbook where I think they stop one step short and should have told you one more thing. So in those cases, you'll see an item in red on the lecture PowerPoint here. So as an example, they don't talk about contribution margin ratio, but I want to tell you about it. So that's how you can distinguish that. You won't see it on your homework, and I probably won't have it on an exam, but I want you to know about it all the same. So the contribution margin, that's a really important concept and important number within a company. A contribution margin is what's left over after we take our selling price and subtract the variable cost. And the variable cost, like I mentioned before, some of that's going to be the cost of making the product, like direct materials and direct labor, and some of it's going to be selling and administrative type cost. So like sometimes insurance is variable. It's based on how much you sell. Sometimes commissions, of course, can be variable. So it's going to be the price of the product minus the variable cost per unit. That's going to give me the contribution margin per unit. So the contribution margin ratio is going to be a percentage. So I can take that same price minus variable cost and I can divide it by price. That'll tell me the percentage of each dollar that is left over to contribute towards covering my fixed expenses and providing for profit. That's where the word contribution comes in, is it's what's left over to contribute to covering fixed cost and provide for profit. So the total contribution margin in dollar terms, we're going to multiply it by the quantity. So it's going to be the contribution margin, which is price minus variable cost per unit, times the number of units we sold. That'll be the dollar amount of contribution margin. So one of the things that we can use this for is to determine a break-even point. And that's really important, especially for companies that are operating at a loss. I guarantee you, if you work for a company or any organization that's operating at a deficit, they want to know how much more do they need to do to get to a point where we're at least not losing money. That's a key question that somebody would ask. So the way we figure that out, the break-even sales in units, designated by the Q there as your book does, we'll take the fixed cost and we'll divide it by the contribution margin per unit. And that'll tell us how many units we need to sell in order for the contribution margin to cover our fixed cost. So break-even sales is where our total revenue equals our total cost and our bottom line is zero, okay, which is intuitive. So here's an example. I have a company with fixed cost. Let's call that rent and depreciation and the president's salary. Pretty low salary for a president, but we'll just use that argument, $90,000. So we have a unit selling price of $25, a unit variable cost of $15. So that means each unit we sell is going to give me a $10 bill. And I want to know how many $10 bills I need to accumulate so that I cover that $90,000 in fixed cost. So I take fixed cost divided by the unit contribution margin of $10. That tells me I need to sell 9,000 units in order to break even. Now I can change that break-even point if I could reduce that break-even point if I reduce my fixed cost, if I maybe rent a smaller space or whatever the case is. I could also change it by changing my contribution margin, by working hard at lowering my variable cost or maybe raising my selling price. If I raise that $10 to $11 or $12, it'll reduce the number of units I need to break even because each unit is going to contribute a little more towards covering that 90,000. I can show this information graphically as well. So in this case, I have my FC line, that's fixed cost. And this is an extension from what we looked at earlier, where the y-intercept is my fixed cost, excuse me. It's fixed cost at the y-intercept. The line that goes across is TC, that's total cost. So that's my cost over the units produced. And then the TR line is total revenue. So at 0 units sold, my revenue is 0, and it goes up based on the selling price per unit is the slope of that line. Where those two lines intersect is where total revenue equals total cost. That's my break-even point. This can be a useful way to explain this concept to people that don't have an accounting background, because they can look at that visually and say, oh gosh, we're in the loss area now. The vertical height of the difference between the blue line and the black line to the left of the break-even point is our loss. To the right of the break-even point, that vertical distance is our profit at that level of units. So your textbook does it in a way that is a bit more confusing, but it is more impressive looking, I'd have to say. So it starts out by saying break even is where total revenue equals total cost. And then they just expand upon that using algebra. So total revenue is the price per unit times the quantity at the break-even point. Total cost is fixed cost plus variable cost times the quantity at break-even. And then you can see I solve for that to get fixed cost by itself, okay? And then I can determine that that's quantity at break-even equals fixed cost divided by contribution margin, which is kind of an algebraic proof of what I showed you earlier. So at break-even, total contribution margin is going to equal total fixed cost. So that's the end of part 1 of the lecture. We'll pick off in the next part by talking about not trying to break even, but trying to earn a target profit. Thank you.